Like 3 times. Yeah, I was like, I was thinking like 3 to 5 times at least. Because everything was like that. All right, Jeff.
Anyway, so. Any snows? Probably still like 100 houses already, right?
You have a scenario?
Yeah.
This is our mask. Yeah. Actually, that's perfect.
I only got that one when I was
So, it was good seeing you. Now, one thing that's a little different. You have kids too. Franchise. Oh, you have books too.
right, huh?
I'm like, my hair is my kid is just so you're doing this now?
Good morning, everyone. Lloyd with My Auction Addiction Estate Sales. We're your Blue Door affiliate that does estate sales, senior moving sales. Basically, we liquidate anything that your clients need to sell as part of that transition. And we have a really great system. If you haven't used this before, come on over to the booth and I'll talk about what we do. Again, Lloyd, My Auction Addiction Estate Sales.
Good morning. I'm Jacinda with Directors Mortgage, and I've been a loan officer here for 16 years. Been with Directors for about a couple years. And one of the things that we do that's really cool is we have an earnest money protection program. So if you guys have any clients that are having a hard time getting offers accepted, come talk to me. We'll reimburse earnest money up to $10,000 if we cannot close the deal for any financing reason. So it's a huge boost of confidence to sellers and a great way to help get buyers' offers accepted. Come see me in the back.
Hi everyone, I'm Jeff. I'm in Albuquerque. We are your trusted local locksmith for all of your locksmithing needs, whether it be your car, home, or business.
I need the mic. I don't talk that loud. Hi guys, I'm Teresa Carter with Water Extraction Experts. We specialize in water damage restoration and mold remediation. We are your one-stop shop from the first moment of you finding mold or water damage all the way up to the reconstruction. I have jerky in the back and cookies, so just saying. Thank you.
Good morning, everyone. I'm Christine Marin Taylor. I am the Senior Vice President of Lending at the newly opened Cross Country Mortgage. And I don't have jerky or cookies, but I'm here today, so thank you for being here.
All right, well, that's all. And actually, I'm going to have Jorge with Fidelity National Title. He is your moderator for today. And our panelists can go ahead and approach, but we're going to go ahead and get the program started. So one more round of applause for our affiliate sponsors, please.
Good morning again. Buenos dias. Thank you all for coming. You guys awake? Will somebody wake me up, please? But sincerely, thank you all for coming. As Nick mentioned, I'm Jorge with Fidelity National Title. I really want to go through some introductions, but I really want to let you know that you're in store for a great program. We've got some great options for first-time home buyers and maybe some not so first-time home buyers as well. A lot of different things that you're going to learn today. It'll be beneficial, and I think you're going to enjoy it. But more than anything else, have fun, learn something, take it in, and know that there's going to be some good things coming for you. As we get started, I want to do introductions, and I'll start here to my right. Eunice Duran is a homeownership representative at the Mortgage Finance Authority. She's been there for 19 years, and if there's anything you want to know about MFA, she's the person to go to. She knows it in and out. I wouldn't be surprised if she never looks at the slides and just talks to you generally, because she knows this stuff left and right like it's the back of her hand. 19 years, she's been great. So welcome, Eunice. And I'll continue down the line. Christine Marin Taylor, she's the Senior Vice President of Lending at Cross Country Mortgage. She's been doing this for 21 years. So her mortgage is now of age, it's legal, and she does an amazing job. She actually started and has been doing different facets of the business, from processing to different types of lending. So she's done it all, and she knows her stuff, and we're fortunate to have her. So welcome, Christine. I also want to welcome Mark Travis. He's a loan originator at Waterstone Mortgage. Mark's been doing this for several years. He knows his stuff. Mark's from here, from Albuquerque. He got his MBA, and he actually has a couple of businesses here and in Colorado. So he's pretty well versed in his stuff, and we want to welcome Mark for joining us, and thank you for coming, Mark. And I also want to welcome Steve Checo. Most of you have seen Steve Checo around. He and his wife, Faye, have been married for 34 years? They've got 4 kids, and he's been in lending for 25 years. So Steve definitely knows his stuff as well. He's a director's mortgage, and he's the non-producing branch manager. Steve's a good guy, good person to know. All of them are, add them to your Rolodex. They're all going to be helpful for you. And we want to welcome Steve, and thanks for everything for what you do, Steve. And lastly, the one I always forget is me. I'm Jorge again with Fidelity National Title. I mentioned my downfall, well, one of them, in not being an escrow officer, but I do help on the marketing side. That's really our forte, and that's what we do best, is help on the marketing side, help you find new opportunities for business. And that's kind of what this program is about, helping you generate new leads, new opportunities for buyers. So I want to get on with the program. And the first thing I want to mention is there's going to be a bunch of acronyms. You should have packets in front of you that has all the acronyms spelled out. This is just FYI, just for those who have FOMO. But you've got a bunch of them. I'm not going to go through them, but we were going through the program together, and I noticed a lot of different, short acronyms that not everybody's going to know what FTHB was. And I was like, what's that? Oh, first time home buyer. And a lot of them, for me, was like, oh, duh. But we decided to write them down for you, so you should have that in your packet and make it a little bit easier. And every once in a while, feel free to LOL. Don't call your MOM. And there's other things that'll come up, but just please enjoy and know that you have that reference for you. And so we'll get started with the program. A couple things to note, and really, I think the most important thing for you to remember is big picture. Don't feel like you have to memorize what the products are, what the programs are. Our benefit, and the reason we're doing this, is for you to know that you have options for your buyers. There are a ton of them. There are at least 8 different programs we're going to go over. They have way more than that, but these are the ones we're going to highlight. The most important thing is not to know and say, oh, I think I have a buyer for that. I think I have a buyer. Instead, listen to the program, listen to what the product is, and you can start thinking about your friend Adam, or your buyer, the Rodriguez family, or the Smiths that are on the other side of town. This might be a program for them that they can take advantage of. Don't remember what the qualifications are, what the down payment is. You don't have to think about those things. Instead, think about your buyers as they're talking about the products and write those down. Write down who you think might benefit from it, and then come up and talk to these folks because they're the expert and they'll help you get your buyers qualified. Does that make sense? So there's not going to be a test at the end, I promise. Feel free to, Tigo came for the CE, and we appreciate Tigo being here. But don't feel like you're going to be quizzed. Enjoy it. There's going to be a lot of information that you're going to benefit from, and take some notes for your buyers and what they can benefit from as well. So enjoy, have fun, and I'm going to turn it over to Eunice, who's going to tell you about MFA.
Good morning, everyone. Thank you for being here this morning and sharing your morning with us. So I'm going to talk a little bit about MFA. And like Jorge said, don't worry. Don't think that you have to remember every little thing that we're going to be talking about. So this slide, definitely, I don't have memorized. It's quite a bit, so I'm going to be reading it from the slide, Jorge. But for those of you that don't know about MFA, there is a little paragraph here that I'm going to read just to give you a little history about who we are. So in 1975, the New Mexico State Legislature created the New Mexico Mortgage Finance Authority, a public body, politic and corporate, separate and apart from the state, constituting a governmental instrumentality with the power to raise funds from private investors in order to make such private funds available to finance the acquisition, construction, rehabilitation, and improvement of residential housing for persons and families of low and moderate income within the state. MFA became the state's governmental designated housing agency in 1977. MFA currently has 125 employees and over 350 partners and service providers. So MFA, outside of just doing our down payment assistance, these are the other resources that we have available. We build affordable rental communities, rehab aging homes, supply down payment assistance and affordable mortgages, offer emergency shelter, and administer rental assistance and subsidies. So we currently have over 40 programs that we have available. But today, of course, we're going to be talking about our down payment assistance. So there's going to be a few programs that we'll be going over this morning. So again, for those of you that are new to the business or aren't familiar with how MFA works, I'm going to talk a little bit about the lender's role. So as far as the lender's role, MFA, we don't actually take the applications through for your clients, right? So what we do is we work with partners, lender partners throughout the state. So all over the state, we have lenders that are approved to do our program, like the three other panelists that we have here this morning. So basically, they're going to do all the work for us, right? So your lender, if you do have someone that you feel can qualify for our program and they're looking for down payment assistance, well, what you're going to do is you are going to refer them over to your favorite lender, and they are going to take the application. They're going to disclose, they're going to process, they're going to underwrite the file to make sure that your borrower qualifies for a mortgage, right? So they have to have a good enough credit to qualify for a traditional mortgage. And then your loan officer is going to say, okay, do they fit within MFA's guidelines? So that's what we're going to talk about today. So once your lender gets your client qualified, then they're going to do a pre-qualification, right? So they're going to say, okay, your client qualifies for this amount. So you guys as realtors, you're going to work with your client, find them that perfect home. And then once they sign a executed or fully executed purchase contract, then at that point, that's when your lender is able to start working with us, right? So what they're going to do is they're going to go into our system. They're going to reserve/lock in the loan for whatever program that they're qualifying for. So at that point, that's when we know that there's going to be a file. And, somebody talked about a one-stop shop. And that's what I think is really great about MFA, because we are a one-stop shop. So your client is going to work directly with the lender, and then the lender is going to work with MFA on your client's behalf. So they don't have to work with your lender and then, do other stuff with MFA. We're going to be working directly with the lender for your client. So it's kind of a seamless process. Now, the one thing to keep in mind, because we have certain guidelines that we're going to, again, talk about later, is before your client can go to closing, right, and to get that loan closed, MFA does have to perform a pre-closing compliance review. And so what does that mean? So MFA, we're not going to re-underwrite the file. We're confident that our lenders have underwritten correctly. But what MFA has to do, as you saw earlier, we're overseen by the state, right? So we have to follow certain rules for our program. So what MFA is going to do is we are actually going to just verify that your client fits within our requirements that we're going to be talking about just now. Once we approve that loan, then at that point, then your lender can go ahead, talk to title, get it all ready so your client can sign those docs. So just to keep in mind about that. Now, a little general information about MFA. So across the board, we currently have 2 programs. So, oh, it's showing here. Sorry, guys, this slide. Right, you can. Do you know? Sorry about that, guys.
Push the little button on the click share.
On here? This?
Sorry, we have no idea.
Oh, this thing? I don't break it. Ta-da!
Oh, there we go. Thank you. Okay, sorry about that, guys. I guess I got to play around with it a little bit more. So general information. So today we're going to talk about 2 programs that MFA has available. So we have 2. So we currently have one for first-time homebuyers. We're going to go over in just a little bit, what does MFA consider a first-time homebuyer? And then if somebody is a repeat homebuyer and they need down payment assistance, we have a program for them as well. So as far as credit scores, your client does have to have a minimum of a 620 credit score to be able to qualify for our program. So if they have credit, it has to be at least a 620 or higher. But if you look down at the bottom, you'll see that asterisk, MFA does allow manual underwriting. So what does that mean? If you have a client that has never established credit before, your lender can actually build credit for them, right? So there's certain documents that we need to, or your lender needs to get from your client to be able to build credit for them. So definitely talk to your lender. But again, if somebody's going to one of your open houses and they get discouraged because they think, well, I don't have credit, right? I wish I could buy a house, but I've never established credit before. Well, don't dismiss that, right? Say, well, you know what? maybe you can qualify for one of our first-time homebuyer programs. Talk to this loan officer, that you want to refer them over to, and then maybe they could qualify, right? If they have the right documentation and the right scenario, why not try, right? So the other rule that MFA has is we want to make sure that our clients are successful, right, in making their payments. So MFA does have a maximum DTI of 50%. So they cannot be over 50% when your lender is getting them qualified, unless they have a non-occupying cosigner. Now, with a non-occupying cosigner, if you have that scenario, just make sure it's going to be a little bit different than what your lender considers a non-occupying cosigner. For us, we still require that the borrower by themselves still be below 55% if there's a cosigner. So they have to qualify still on their own as far as all of their debts and their house payment, right? So that one's a little bit harder. And then the other thing about a cosigner, it's a little bit more restrictive, where it can only be an FHA loan and for our first home, which is our first-time homebuyer program. So it can't go with all of the options that we have. Also, for any first-time homebuyer that we have, we do require a homebuyer education class, and it has to be a HUD-approved class on our website. They're listed there. And then, of course, your lender is going to let your client know what's available. As far as property types, so MFA does allow single-family home types, right? So we can do a detached site-built home, townhouse, condo, as long as it's warrantable, homes in a PUD, manufactured homes. Now, this is what's really great about manufactured homes. Of course, as long as they're on permanent foundation already and they fit within, FHA, Fannie, Freddie guidelines. But we allow single and multi-section manufactured homes. So with the affordability being outrageous for first-time homebuyers, that's another option. And this is pretty new as far as the single wide. That's probably about a year ago that we've been able to allow that. Now, the one thing, I have this here, what is not permitted is we do not allow 2 to 4 unit properties. So if somebody wants to buy a duplex, live in one, rent the other, MFA does not allow that scenario. And I mentioned earlier, as far as why MFA is so easy to work with, so I do want to say it's easy to work with, is that really your lender is going to determine what best fits your client, right? So our program can be used with FHA, VA, USDA, HUD Section 184, FHA 203K. We have Freddie Mac, HFA Advantage, Fannie Mae, HFA Preferred. So basically, whatever your client's picture looks like, your lender is going to determine that, right? Is an FHA loan better or is a conventional loan better? Because I think a lot of people think that it's only FHA, MFA, but not really, right? Like we have a lot of options. And what does that mean? Well, with these programs, they're either 3% or 3.5% down payment requirement. And then that's where we come in to help with that down payment. Now let's talk about our first home program. So this is our core program. And again, this is our first-time homebuyer program. So who's a first-time homebuyer for MFA? Well, it's available to first-time homebuyers, right? So who's a first-time homebuyer? Obviously, someone that's never owned a home before, right? They're buying a home for the first time. But we have some other rules that you'd be surprised that maybe more of your clients could fit in. We have a 3-year rule. So our 3-year rule says if somebody's owned before, right, as long as they haven't owned and occupied that property as their primary residence for the last 3 years, then MFA could consider them, and I'm going to say could, consider them a first-time home buyer, and they'd be able to use our first-time home buyer program. Okay, so again, don't dismiss somebody if they say, well, I've owned in the past, because you know what? If they fit within our requirements, then maybe they can benefit from this program, right? Veterans waiver. Something else that a lot of people don't realize is if you have a client that's a veteran, we have a special waiver for them. So they don't have to be a first-time home buyer and still benefit from our first home program. So what's the benefit of using first home? Well, they're going to get, you'll be seeing a little bit later, they're going to be getting more down payment assistance as well as a lower interest rate. So we'll talk about that in a little bit. But if you do have a veteran, just make sure that your lender is going to provide them with an affidavit of veteran that they have to get notarized and signed. And then they also have to have their form or their VA form DD-214. So those are required. But if they have that, then we waive that first-time homebuyer requirement for that veteran. And then also, if somebody is currently living in a manufactured home, but it's considered chattel, meaning that it's not on permanent foundation. Well, they can still own that manufactured home as long as it's considered chattel and then still be able to buy another house, right? They can rent out that manufactured home and then buy another house using first home. Now, for those of you that don't know, if your client's going to be using MFA, they have to get our first mortgage, right? So it's kind of a package deal. They're going to get their first mortgage through MFA as well as their down payment assistance if they need it. So our first mortgage for first home is going to be a 30-year fixed loan, and MFA sets all of the interest rates. Now, keep in mind, we can change the rates on a daily basis, but let me give you an idea. Our rates are phenomenal right now. So for a first home, if you're doing a government, so if you're doing FHA, VA, USDA, today our rate is at 6.375 at 0 points. So at par, which is insane, right? So let's go back to that manufactured home, okay? So with that manufactured home, if you have a client that wants to buy a manufactured home, guess what? They're going to get that same rate that we have to offer. If they're doing FHA, 6.375. We're not going to do loan level pricing adjustments for the property type. The other thing too is, remember we mentioned that they need a minimum of a 620 credit score? Well, on that, we don't care if they just have a 620 or a 780. We don't do loan level pricing adjustments for that either. They're going to get that 6.375% rate. So if you have a client, A, that's buying a manufactured home and has a lower credit score, they're going to get that 6.375 rate. Isn't that amazing? That's like unheard of, right? And then if you go conventional for a first home, it's a little bit higher at 6.75, but still fixed for 30 years. So very, very competitive. We don't have any prepayment penalties on any of our loans. So if they want to pay them off early, they definitely can. And then as a reminder, all first-time homebuyers, they need to take our HUD-approved homebuyer education class. So another exciting news that I'm sure you guys have heard about, on June 17th, we actually got new income limits and they're higher. So for our program, I had mentioned your clients have to be within a certain income, right? So we're for low to moderate income households. So depending on the county, that's where you're going to see what the maximum income is. So for Bernalillo or Albuquerque MSA, it's Bernalillo, Sandoval, Valencia, and Torrance counties. If there's a 1 to 2 person household, the maximum income is $91,565, and for 3 or more, it's $105,300. So they've gone up significantly, right? So just keep in mind, if you take a look down at the bottom, and then any other county, of course, is going to be a little bit different, but down on the bottom, you're going to see it says, remember, there's a difference between qualifying and MFA household income. So this is where you have to work closely with your loan originator, because MFA, the way we look at this, it's going to be different, right? So if your lender is doing qualifying and they can't use certain income for some reason, well, just remember, for first home, MFA is going to count every single penny that your client is currently making today. So they have to disclose that to us. There's a document that they sign and they fill out the people in their household, and then also they need to let us know if they got a second job 2 months ago. We're going to count that second job, even though your lender may not be able to, right? So just keep that in mind. And again, you can talk to your lender about that. But really exciting that those have gone up. Now, something else that went up is our purchase price limits. So if you go down to the bottom, you'll see all other areas of the county. So it's 510, 939, which is pretty insane, right? So keep in mind though, depending on the income that your client makes and what they qualify for, but in Albuquerque and all over except for Santa Fe and Los Alamos that are higher cost areas, that's going to be the maximum purchase price that MFA allows. Now let's talk about the down payment assistance that they can get. So the first option, and keep in mind it's optional, right? So if they're going to get a large gift, then they can bring in their own down payment. But for the most part, people use MFA because they need down payment assistance, right? So this is the first option. And what this is called our first down. It is a second mortgage, and it has the same income and purchase price limits as first home, of course. So what they're going to get, or what they can get, is they're going to get up to 4% of the purchase price to help them with down payment, prepaids, closing costs. So whatever the purchase price is, they're going to get 4% of that. And they have 3 options as far as terms. So they can pay it off in 10, 15 or 30-year term. It just depends on, what they can afford and what they're, again, we're going to talk about debt to income ratios again, what they can qualify for. And then, of course, if they choose a lower term as far as payment, then the rate's going to be a little bit lower on that second. And I do want to say, just keep in mind that all the programs that we're talking about today, they're all going to have to be paid back. Like, we don't have any grants available currently. So all of these are going to have, payments to them. Now, another one that we just released, gosh, I think it was in April. So this is another program, and it's called our First Down Plus program. Now, what this is, it's a third mortgage. And so this can be also with that first home, first down, right? So if somebody wants to get this First Down Plus, they have to get our first home first as well as that first down second. So all three. And what they're going to get is they're going to get a flat amount of $10,000, which is going to go directly towards down payment. So they have to use the full 10 for down payment. And the maximum combined assistance for the first down plus the first down plus, the two of them, is going to be, it can't exceed $35,000. So again, depending on the purchase price, they can get up to $35,000 in down payment assistance help through MFA, which is, incredible. As far as this program, we've changed it a little bit, it's going to be $10,000 at a 15-year term. So it's going to be a 15-year term. Their monthly payment is going to be $55.56, but it's at 0% interest, and they can pay it off at any time. So again, it's really great if they want to also add this to it. But again, just keep in mind, if they want this, they have to have all three, right? First home, first down, and then this first down plus. You see in red, this does have limited funding, but the good news is we got new funding now in July, so we have plenty of funds available for this if your clients get to use this. So now let's talk a little bit about targeted areas. A lot of people don't know or haven't heard about targeted areas, and so we're still talking about first home, first down, right? So targeted areas are census tracts identified by HUD as having at least 70% of the residents with income at or below 80% AMI. In January 8th of 2024, we've had some updates and some changes. So I'm not going to go over this just for the sake of time, but just know some counties have lost targeted areas, some have increased, and that's why I'm going to talk about it today, because Bernalillo County has almost doubled in the targeted areas, and we're going to talk about, well, what's so good about targeted areas. We'll talk about that. But as far as generally, New Mexico has 11 targeted areas within the state. So what are the benefits of targeted areas? So I mentioned they're still going to be getting that first home program, right? But if they're going to be purchasing a home within these specific targeted tracts, then MFA is going to waive that first-time homebuyer requirement. So if you have a repeat homebuyer, well, guess what? They can still benefit from using that first home, first down. And again, remember they still get more down payment assistance and so on. Also, there's higher income and purchase price limits. And so on the website, we have those listed. So I don't have them on these slides just to keep it shorter. But anyway, the best thing is we're going to go back. The day that the lender locks that loan in, we're going to go back 12 months and we're going to see what our lowest rate was in the last 12 months. And your client will get the lowest rate we've had in the last 12 months, which is, just to give you an idea, it's probably about 0.5% better than the rate that I had mentioned earlier today. So what does that mean, right? Gives them lower rate, more buying power. So it's all a bunch of pluses here. So these are the areas. So for those of you that remember targeted, we only had 6, now we have 13. So essentially where these areas are, just to give you a quick idea, is like in the southwest part of town, southeast part of town, near the fairground area, downtown, kind of in those areas. But I'm going to give you an example really quick. I know it's going to be hard to see, but on our website, if you go into our website under the lender realtor section, there's a button that says targeted areas. If you click on that, it's going to have the income and purchase price limits, but there's going to be a lookup tool. And the lookup tool is actually this website here, which is the ffiec.gov, okay? So what you're going to do is you're going to put an address in there. So my example here, I just found it on Zillow, so I don't even know if it qualifies or not, but just as for educational purposes today, you're going to keep it at the 2024 year, right up at the top, and you're going to put your address in. So if you can see, the address that I have here is the 824 Silver Avenue Southeast. So what you're going to do is you're going to press enter, and then what's going to happen is that grid is going to be empty until you put the address in, and that grid's going to fill in. So what you're going to do then is it's going to bring up the map, and I don't know if you can see or not, but right above lead, there's like a red dot. So that red dot is where that property lies. And then within that, if you can see kind of in the middle, it's in blue, but it says 15.00. I don't know if you can see that on the map, but if you look at the left side of the grid and you go to tract code, you're going to jot that number down. So you're going to say 0015.00. And then what you're going to do is you're going to go back and you're going to compare it to that list. And guess what? We have a bingo, right? There 15.00 is in a targeted area. So if you had a client that's going to be purchasing that home, then they get all those wonderful benefits. So if you have, so just as a sidebar, if you have current listings in those areas, definitely look into this. Talk to your loan originators, right? The guys that are up here, and they can help you, right? Or just have them do all the work for you. I'm volunteering them, or call me, because I'm just going to do really quick, obviously today. But if you want more information, I mean, this is great to get people, to benefits, right? They get lower rates, they get down payment assistance, so it's nothing but wins for this particular program. So now, the last program I'm going to talk about is if you have clients that maybe are over income for our first home program, or again, they're not first time home buyers for some reason, right? So we have another option for non-first time home buyers. And so what it is, it's called our Home Forward. This one, again, is a 30-year fixed. It's a first mortgage. But what's nice is it's available to first-time homebuyers or repeat homebuyers, right? So again, if somebody's over income and they don't qualify for our first-time homebuyer program, your loan officer could then see if they qualify for the Home Forward program. And as far as that, they can use it as a standalone if they want to come in with their own down payment. But what they're going to receive is they're going to get a second mortgage for down payment assistance, and they're going to get up to 3% of the purchase price to help them. But the thing is, the 3% has to go directly to down payment. It can't be used for closing costs. So keep in mind, they're going to probably have to come in with a little bit of money on this particular program. But it at least helps them with some down payment. And then again, as a reminder, even if they're doing Home Forward and they're a first-time homebuyer, we still require that they take that approved homebuyer education course. And this is going to be hard to see too, so I apologize, but I think on your paperwork you have it. So we also had an update in June for our Home Forward as well. So, and this one is per county. So if you look up at the top in Bernalillo County, the purchase price limit is higher. So it's $567,710, and then the income limit is $129,750. Okay, so what's so great about this? Okay, well, on this particular program is we're going to use your lender qualifying income. On this program, whatever your lender's qualifying income is, as long as it's below these income limits, then we're not going to count every single penny that your client makes, right? So another good reason to try to use this program if they don't qualify for our first home. I'll say your loan officers are going to try their hardest to qualify them under that first home program because our interest rates are lower. They get more down payment assistance options, right? So on this one, if they qualify for this, they're still going to get that 3% for down payment, but the rate's going to be a little bit higher. So it's actually today, if they're doing FHA, it's going to be 1 point higher. So it's at 7.375 today if they want to do this. But again, it's still a pretty good rate, but then they get down payment assistance as well. Now with that DPA, I mentioned that they get 3%. To help them with down payment. Now they have two options. So they can pay it off on either a 10 or a 15 year. So again, the shorter the term, the lower the rate on that second. They do have to make monthly payments. So I mentioned before, none of our programs are grants anymore. They all have to be paid back. But the great thing is there's no prepayment penalties on our programs, right? So they can double up on payments, pay the loan off early, and they don't have to pay any penalties on that. So I've come to the end. And so what I do want to say is, we value our partners, obviously. MFA's homeownership programs would not be possible without the help and hard work of our many valued partners. Lenders, realtors, appraisers, title companies, homebuyer education providers, nonprofits, inspectors, investors, all play a key role in getting our programs to the people who need them. So in 2023, with your help, MFA assisted over 1,845 New Mexicans become homeowners. And we are on track to exceed that this year. So, our sincere thank you to all of you that are really pro MFA. I do know that sometimes it feels like maybe it's a little bit harder to use our programs, but just know our goal is the same as your goal, right? What do we want? We want to get New Mexicans and homebuyers into homes. So we all have to work as a team. Unfortunately, we do sometimes have to ask for certain documentation just to make sure that, again, going back, that your client fits within those requirements that MFA has, right? So, but again, we all have the same goal. I talked about we have to do a pre-compliance review before your clients could go to title to sign their closing docs. Well, we have been at like a one-day turnaround time, at one business day turnaround time for, gosh, about a year and a half now. So I know people have that preconception, right? Oh, MFA takes forever. And not really. We're going to try our best. Now, keep in mind, even though we're turning it around pretty quickly, if we have questions, it might take a little bit longer, right? If we need additional documentation. And then, of course, your lender needs time to, to get the closing docs and everything set. But know that we are trying our hardest to be able to get those loans closed for you. And if you have any questions, if you are wanting to learn a little bit more in more detail, definitely don't be afraid to reach out. I'm always here. I do lunch and learns. I do one-on-one trainings. Whatever you guys need, I'm here. So here's my contact information, my cell. Probably text message is best, but thank you again for your time. And thanks, Jorge.
Folks, just a quick side note. You have the handouts. Jot down your questions as they come up, because we're going to go through the whole program and then we'll do a question and answer. So if you're like me and forget stuff from 1 minute to the next, you might want to jot it down. Thanks.
Good point, Steve. Thank you. And you should be writing down your buyers, right? You have your buyers written down. I mentioned there wasn't going to be a test. I think the only thing we're going to test today is your eyesight. Just kidding. But I do have a little piece of release for you. All of the slides are going to be on the GAR blog. So, and they'll be nice and big. They'll be easy for you to read. So don't feel like you have to, squint right now. They'll be available for you. So good information, right? Beneficial? Good. How many of you have potential buyers for MFA? Anybody? Good. Good. First down, first time, first everything. There's good options for you. And we want to bring up Christine. She's got some other options. So if, first home's not going to be your the best opportunity for you, maybe there's some other options for you. So we'll have Christine Marin Taylor come up and tell you some more. Let's give her a round of applause.
Good morning again. I guess you have to stand really close, get some lipstick on there. All right, I'm Christine Marin Taylor. It's like the 5th time I've told you my name rhymes, okay? And I am the Senior Vice President of Lending at the newly opened Cross Country Mortgage here in Albuquerque. I'm going to talk about some programs that are definitely related to what Eunice brought up. They are called Home Ready and Home Possible. So I'll just take a pit stop here and let you know. Okay. Don't be that close. Okay. I was just instructed. I wanted you to hear me. Okay. So Cross Country was founded in 2003. It's a mortgage lender. So it's licensed in all 50 states and Puerto Rico. We have 200 mortgage products, which is why I chose them. They just hit the #1 retail lender across the country, and they're one of the fastest growing companies as well. So I think last week their employee count was something over 7,000. They have a lot of processing and underwriting staff. So we will talk about Home Ready, and this is a product by Fannie Mae, and I just want to point out how beautiful that picture is with the mountains, because Albuquerque is gorgeous. It looks like that all the time to me. So Home Ready is a low down payment program offered by Fannie Mae. It's designed for below median income borrowers. The area median income, which I know we've already thrown at you, we've called it AMI. This is a term. It's on your sheet. Write it down. Oh, just kidding. The area median income, also AMI, varies per area and changes annually. So I included a link here. It is in your slides. You can't click on it, but you could type it in, and this will bring you to this next website. Okay. So I typed in an address. It's in the Northeast Heights. It's really at like Eubank and Lomas. And so the area median income is 86,400, and it did a little, square around that little block. But the program, the requirements, so it says home ready income limit is 69,120. So notice how much lower that is than MFA. So they are really working hard to be able to offer you that program at that high income limit. So this program, though, this is generally for somebody who has reasonably good credit. This is somebody who, the rate on this might be lower than the MFA conventional option. But these people are pretty low income. Being 69,120, we've got a tall order here. So some of the highlights for Home Ready. You can go up to 97% loan to value, not for manufactured homes. So that's kind of a drawback. These are fixed rate only. So no ARMs, no 3, 1, 2, 1, 5, 6, 7 buy downs, which really aren't the best anyway, because they're going to go right back up to that high payment. Reserves. So reserves are basically after you put a down payment and pay your closing costs, how much money does the borrower have left over in their, just sitting in their account? That's a reserve. So that's determined by the automated underwriting system, which is what AUS is. On Fannie Mae, it's called DU, which is really desktop underwriter. Not that you have to remember that, but I just want you to know all these little things I'm putting in here. So I would never say, reserves are required. It has to be run through the automated underwriter to find out. It only can do 1 unit primary residences, but there's a caveat to that as well. They cannot own more than 1 property. So what that means is they can own a property. They don't have to be a first-time home buyer. Maybe they just own another property somewhere else. That's totally acceptable, but only 1. So this person can't, I'm going to build my real estate empire. Not with this program. Yeah, that's right. Just that first one. So there's no minimum borrower contribution. So what's really neat about that is they can get the whole down payment on the closing costs from a gift, a grant, and this program allows for community seconds. So that's the HFA preferred program that MFA uses. So it's this program a little tweaked, and that's their conventional loan. So that means they can get their money from pretty much anyone, because now there's no longer a requirement that the gifter is your family. So there's some options in there. It does have a minimum of a 620 credit score. However, the automated underwriting system might not approve it with that score because it is a conventional loan. So it's going to scrutinize it a little harder. DTI, we didn't learn that. We do. Most of us know that. But debt to income ratios are also determined by the automated underwriting system. So for example, which is not this program, but if you did like an FHA loan that was an MFA, it might let you go up to 57% DTI, but MFA stops you at 50 because that's the program requirement. On here, it will never be above 50. It would never approve it above 50. And sometimes it might not approve it at 45. So it's really scrutinizing the borrower. So it's determined by the automated underwriting system. The income for this program needs to be between 50 and 80% AMI, which was that area median income. Homebuyer education is required if they are first-time homebuyers. So if they own that other home, they don't have to do it. One of the big benefits here is there's reduced private mortgage insurance. So if you were just a person who wasn't within this AMI, and you put 5% down, you would have 35% coverage on mortgage insurance. It reduces it automatically on this loan to 25. So MI is cheaper on this program. And one of the reasons you would want this instead of an FHA loan is the mortgage insurance is cancelable. So it's not that the borrower has to do anything, but after about 10 years, it will fall off automatically. Cool, we save $150 a month, or, you know. On FHA loans, which would be the comparison, it doesn't come off when they're putting the minimum down payment. They have to have it for the life of the loan. So this is another major benefit. This person might not have to refinance, you know, if rates take 20 years to come down. Just kidding. There are also no loan level pricing adjustments. So Eunice had mentioned that as well on MFA. So loan level pricing adjustments are the risk associated with the loan. So if your credit score is low, you're higher risk. If your down payment is low, you're higher risk. All these things add up and change the risk on a loan. On this loan, they do not change the rate based on your risk. So that's why I'm saying this rate might be comparable to the one MFA is offering, and that could be beneficial as well. Okay, some additional information is if you did a single family residence, it can go up to 97% loan to value. Of course, that would include, you know, condos, PUD, attached homes, anything where a single family residence is. Same for condos. Manufactured housing will allow you to go to 95%. However, this specific program requires that it's an MH Advantage manufactured home. And pretty much none of us have ever seen that because it's almost impossible. You have to have it almost has to be built like a regular house. It has to have a poured concrete driveway and a porch and all kinds of stuff. And then if you meet all those rules, then there has to be a label in there that says MH Advantage. So this is probably not the program for a manufactured home. And look, there is a 2 to 4 unit option. So you can use this. It has a 5% down payment. So it's 95% loan to value. If the down payment is 20%, then there is no minimum borrower contribution. So, hey, we're going to buy a 4 unit for our kid and he can live there and he's on the loan and parents gift the 20% down, fine. But if it's over 80%, then they have to have their own contribution. A non-occupant cosigner reduces the loan to value to 95%. So basically, you sent a first-time home buyer, they got great credit, but man, they need a cosigner. Okay, well now they can't go to 97%. So there are several little, caveats in there. The 2 to 4 unit must have a 3% minimum borrower contribution. So that's where that, I bought a 2 to 4 unit. I have to have my own cash in this scenario. Max seller contributions. So if the loan to value is 90.01 to 97%, the seller can contribute 3% toward the buyer's costs. Things that are not included in that are commission. Yay, because wow. And then, of course, any fees that are traditionally paid by the seller, like maybe the title closing fee or the owner's title insurance, those do not count towards these caps. If the loan to value is 80 to 90%, a 6% contribution. And if it's less than 79.99, it can be a 9% contribution, but there would have to be a lot of closing costs because those cannot go toward down payment. All right, so that was Fannie Mae. So now we're going to look at Home Possible by Freddie Mac, and look, it's the same house, just a little different because it's the same product. It's just a little different. So Home Possible is a low down payment program offered by Freddie Mac. It's designed for below median income borrowers. And guess what? They have an AMI lookup tool. And I put in the same property and got the exact same results. So you can go to either of their websites, get the same information. And here we go. So up to 97% loan to value, not for manufactured, fixed rate, reserves determined by AUS, 1 unit primary residence. You cannot own more than one property. So I feel that this is pretty much identical. The credit score is determined by AUS, but I can tell you that it's not going to approve something low. Conventional loans usually have higher credit requirements. We're again at income between 50 and 80% AMI. It's identical here. We've got only one difference. So I'm going to go right to it. Manufactured housing up to 95%. But it can just be there's no requirement to have this really ultra high manufactured home. It can be just a regular manufactured home that meets the requirements of the state that have been, changed to real property, deactivated title and that. So this is a similar program to the last one. And so if you did have a buyer who needed that, I would then take them on the Freddie Mac program. So everything else is the same. So there is also something called very low income, and it applies to both programs. So these are people under 50% AMI. And so we already saw that 80% was 69,000. So under 50 is pretty low. And what will happen is both Fannie Mae and Freddie Mac will contribute $2,500 to these borrowers. It's I'm going to say free money. It's a grant. There's no repayment. It's just, here's a credit of $2,500 because of the low income situation. Now at Cross Country Mortgage, we have something called CCM Smart Start. So this is what we provide. If the borrower is under 80% AMI, it has to be 97% LTV, one unit only, one borrower has to be a first-time home buyer. So this is specifically for a first-time home buyer. The borrower would contribute 1% for down payment. And then we would give them 2%. If their income is less than or equal to 50% AMI, we will give them 2% of the purchase price up to $5,250. And if their income is greater than 50% AMI, but less than 80, right? So they're still fitting in these programs, we would give them 2% up to $4,000. And when I say give, we're giving it to them. So there's no repayment, there's no qualifying with it. It is just a credit. Here's money towards your down payment. So this would be someone like in the $250,000 range. And now they only have to put 1% down, and maybe you did an amazing job and you got the seller to pay the closing costs. This person got in with pretty low down. And of course, none of those count toward IPCs, which are interested party contributions. Here's my cool disclaimer. I just want you to read it. Can you read it from over there? Yeah. Yeah, okay, we'll keep going. So thank you. I'm Christine Marin Taylor. If you have any questions, feel free to call, text, email. I'll be happy to help. Thank you.
So does anybody, I saw some people writing stuff down. Does anybody have Home Possible, Home Ready Homes? Great options. You get some free money. Good things. So if you didn't write a name down, just know, ask Jolene, ask Tigo, we need more listings. So that means you have to sell your house and then you go become a buyer. So that's kind of a lot of obligation. So do what you can. Yes. Minor detail. But good. We've got Mark Travis coming up. He's going to talk on behalf of Waterstone and tell you about some of the options he has. Welcome, Mark.
Good morning. Thank you for being here today. I'm excited to be here today to talk to you about a couple programs that are a little bit different than Eunice and Christine's. So my name is Mark Travis with Waterstone Mortgage. A little bit about Waterstone for those of you that haven't worked with us before. We were established in 2000 and we are headquartered in Wisconsin. We also are a depository, meaning that we can lend in 48 states. So if you have clients that are moving, I could help them in up to 48 states. You wouldn't have to have them use another lender. We also have over 700 employees. So we're able to lend in all the states except for Hawaii, New York. What makes Waterstone a little bit different? Some of the things that make us different is we have in-house underwriting. We have local processing and local closing. We have a great appraiser list, which is crucial in today's time with some of the appraisers that are out there, and they have to meet certain criteria to be on our list. We have above a 95% customer satisfaction on our closed loans, and we are all strategic minded in order to figure out the best option for your loan. We also do portfolio lending for those one-off loans that make business sense for us. So today I'm going to talk about some programs that might be for first-time home buyers, and they could not be for first-time home buyers as well. The two programs that I'm going to talk about today are our Waterhouse Powerhouse 100 and our Wealth Builder. So both of these loans require both of these loans both go over your FICO score, which for those of you that don't know, that's your credit score. And the acronym FICO is Fair Isaac Corporation. Just some facts for you, because I had never known that until I looked it up. They both include mortgage insurance. That's MI, so there's a mortgage insurance premium that's included into the loan that's financed into it. That's for, your anything under 80%, over 80%, sorry. And both of these are adjustable rate mortgages. They are not assumable or convertible. The minimum loan amount on both of these is 97.01%, and these are both conventional loans. So our first one is our Powerhouse 100. So our Powerhouse 100 creates homeownership within reach with no down payment. So this is 100% financing for loans up to the conventional conforming limit of $766,550. The adjustable rate mortgage on this is going to be a 5.6, 7.6, or 10.6. So what that means is for the first 5 years, it's locked in, and then every 6 months after that, it will be adjusted, or 7 years, or 10 years, kind of depending on what's best for the borrower. The FICO score or credit score can go as low as 720. This is a primary residence only. Unlike some of the other programs, there's no income limits for this program. There's no first-time homebuyer requirement. However, there is a 1% homebuyer contribution that can be given as a gift. So the Powerhouse 100 is a one-unit primary residence. The max DTI, debt to income, is 41%, and that includes your mortgage insurance premium being into the loan. We allow warrantable condos and PUDs. There is a max seller contribution of 3% for this program. For student loans, this is something we come into all the time. If people are deferred, we still have to count that payment on their DTI. So 1% of their student loan balance, if it's not showing a payment, they have to have 2 months of reserves, which can come from a gift. And a reserve is your mortgage, right? If it's $2,000 a month with, PITI, then you need to have $4,000 in the bank. That's your reserves. You cannot keep your departing residence while you're doing this program, and it is for 30 years. Things that are not available are your I-10 borrowers without social security numbers. We can't do this program for that. Non-occupant co-borrowers, 2 to 4 unit properties, manufactured homes, or non-warrantable condos. The ideal buyer for this is somebody who is over MFA income limits and needs a lower down payment and down payment assistance. A lower payment and down payment assistance. The next product we will talk about is our Wealth Builder. Our Wealth Builder is similar to the Powerhouse 100, but in the sense that it allows no down payment. There's no down payment required. It helps build equity quickly, and there's lower monthly mortgage payment because we finance the MI premium into the loan. So this one can go up to 103% loan to value. We also have this loan that can go up to $1,149,825 for those buyers that have a lot of income, need help with down payment. This is a great option for them. So with the Wealth Builder, this is for a primary residence only. It's a 7.6 or 10.6 arm. The credit score is 680, but you can only go up to the conforming limit. If you have a 700, then you can go up to the 1.14825 limit on a home. There is a 43% max debt to income, and once again, that includes your mortgage insurance into the loan. As the other one, there's a 3% max seller contribution, 2 months of reserves, and $1,000 or 1%, whichever is greater, contribution from the buyer. So things that are ineligible for this: non-occupant co-borrowers. You can't do buy downs with the Wealth Builder. So buy downs are, a big thing right now. Unfortunately, we are not allowed to do it with this program. 2 to 4 unit properties, manufactured homes, properties exceeding 20 acres, or once again, I-10 borrowers that don't have social securities. The ideal buyer for the wealth builder, some people call this the doctor's program, homes for heroes, things like that want to go a little bit higher, got out of school, got an offer letter, are going to make quite a bit of money. This is a great product for them just because it helps with the down payment. So once again, my name was Mark Travis with Waterstone Mortgage. If you guys have any questions on any of these programs, please feel free to reach out. Thank you guys very much.
Thank you, Mark. Well done. So again, don't hesitate. You have buyers that maybe don't have down payment. There's some options for them. It's good options. And doctors, professionals, that's great. So good options. Well done, Mark. Thank you. And now we'll welcome Steve Checo.
Morning. Thanks for joining us. We appreciate you coming out the day before a holiday. As Jorge said, I'm Steve Checo. Most of you probably know me. I'm with Directors Mortgage, and we have a couple of first-time home buyer programs that are a little bit different than MFA. But I want to preface by saying that MFA is your go-to first-time home buyer program. If you don't fit into those, then there's a couple other options that we can offer. Chinoa is one of those programs. It's one program, one set of guidelines throughout the whole country. You can do a 3.5% or a 5% down payment, and it's all FHA loans. It may be repayable or forgivable, and we'll go over a couple of those. As far as CBC or Chinoa goes, they've been incorporated since 2013, and that was by the Cedar Band Corporation of CBC, and that was an enterprise wholly owned by the Cedar Band of Paiutes in Utah. So let's talk about the terms and the rates. So the repayable first or second is behind a FHA first. It's a 10-year note, and it goes with a monthly payment, which is due on the second. We also have a forgivable option. That's a 30-year term with a 0% interest rate. This loan does not require a monthly payment, and it's forgiven after a certain amount of time. With the 3.5% forgivable, it's forgivable after 36 months if you've made on-time payments. With the 5%, you're looking at 120 months. And again, that's behind the first FHA mortgage. There's no conventional option here. This is kind of reiterating what the parameters are for this program, but basically your DTI is going to be based on your automated underwriting. And if you are below a 640, you're going to need to be at under 50%. So with the AUS approval, then you use that as your parameter. They've suspended manual underwrites on this program, so right now we can't do those manual underwrites. And there's no overlays. It's strictly following FHA guidelines. The same thing with the MI. It's strictly with FHA. With the home, we'll talk about home buyer education too. I'm going to just pass through these. You guys can take a look at your handouts, but with the down payment assistance, You take the appraisal value or the purchase price, whichever is lower, and either the 3.5 or the 5%. In this example, it's a 3.5%. If the purchase price is 280 and the appraised value is 285, we're going off the 280. You times that by the down payment assistance, which is 3.5%, and you have $9,800 towards your down payment. Just a side note, with this program, normally what we'll do is we'll take the 5% down. This way we have 3.5% down towards the actual down payment, and the other 1.5% we can use either towards your buyer's closing cost or towards a discount if you are buying the rate down. So with the borrowers on the transaction, if they are greater than 640, then there's no home buyer education required. The borrowers with a 6 to a 619, they have to do counseling through Money Management International, and CBC picks up the cost of that, so there's no cost to the borrowers. The same thing at 620 to 639, they have to have the home buyer, but that can be through any HUD approved counseling. They can take the course as soon as their loan's registered, and it has to be done by the time they're ready to close. So how do you calculate median income? Because with median income in this program, if you're under 135%, your pricing, meaning your rate's going to be better. It doesn't have income limits, so you can go, and that's one of the things that an aspect of this program that we can't do with MFA. So if we're trying to fit them into something so we can make the transaction work, because if anyone knows me, they know that we usually do the hard stuff and we figure out a way to get it done. That's one of the things that we can do is the no limit income is available. If you want to Chinoa Fund, if you go to their website, you can see what the AMI is. They have a little worksheet. It's really simple, spreadsheet, and you can fill that out. Or you can go to the HUD website, whichever works for you. There's another program that we have also. We call it 100% financing. It's designed to increase home ownership opportunities for low to moderate income, and the down payment is available. With both programs, at Chinoa as well as this one, you need a credit score of 600. So it's a little bit lower than MFA's, but again, if we can fit them into MFA's program, that's the way you're going to go, because your rates will be much better than most any other program at this moment in time. So the minimum score is 600. The DTI is 45% if you are at a 660 or below, and programs not available in the state of Washington. So with the DPA, with the forgivable second, it's up to 3.5% of the sales price or the appraised value. Now, I have to mention that since we made this program, the slides up, they have added just the other day 5% also for the down payment assistance on this program as well. It's forgivable after 36 months or 36 consecutive on-time payments, same as Chinoa. 30-year term, no interest and no payment, which is helpful because that reduces the amount of their outgoing. Their debt to income ratio is a little bit better. So there's no payments for the life of the loan. The second lien's due and payable, though, if you're going to pay off the first or refinance it, they do not subordinate. And if, for those that don't know what subordination means, it means if you're refinancing the first, then the second would stay in second position. They would subordinate or stay in second position. That doesn't happen here. If it's paid off, then the second has to be paid off. The loan amounts are rounded up to the nearest dollar, and the soft seconds, either 3.5 or 5, forgivable after 36 months of on-time payments. You also have a 10-year fully amortized repayment. That one, it has to be paid on the first of each month, and it has to conform to the federal RESPA and TILA guidelines. The payment is included in their debt to income ratio, and again, cannot be subordinated. So in closing, what I want to talk about in these two programs is the fact that if we can't fit them into the MFA program, then we still have some options. But any of these lenders here are able to do the MFA program. So that's going to be our first shot. And if we can't do that, then we'll try and find another program that can fit. Because the bottom line is, in this market, we want to make sure that all the transactions we do get, we can get closed, because you know how tight the market is. So again, thanks. We appreciate your time, and we'll follow up with some questions. Jorge, take it away.
Thank you, Steve. Good job. Well done. So we do have it open up, definitely plenty of options, right? Good information, beneficial. Just nod your head yes. Make sure you're awake. So if you all have questions, we can address some of those now. The only thing I'll kind of mind you of is, obviously we all got to, we got busy days, but if you have specific questions for a buyer, that's what the experts are for. I have a buyer, my uncle's looking at this and that. That's maybe a good idea to go up to them individually and say, what can you do for this? But are there any questions about the programs or products or other options that are there? Don, what question you have?
Christine, on our Home Ready program, you said that you had a mortgage insurance that was cancelable, but after 10 years, it fell off automatically. What else can the owner do to trigger that prior to 10 years?
That's it.
Ooh, well done.
Hey, oh my God. Okay, I'll keep it over here. That's actually an amazing question. So there are multiple ways to remove mortgage insurance on conventional loans. So number one is the one I mentioned, where they do nothing and they make their payments on time. Well, they have to do that. And then when they are scheduled, so this has nothing to do with their appraised value or paying it down fast. When they are scheduled to hit 78% of the original purchase price, it automatically falls off. So that's option A. Option B is maybe they're making lots of payments because they're like, I'm going to pay this thing down, right? So after 2 years of having mortgage insurance, they can write a letter to the servicer and request that they remove it. Generally, they would have to have made all their payments on time, and then the lender will most likely require an appraisal. So the lender would order one. And then if they were at or below 80% of the value at that point in time, they could cancel it at that point as well.
Way to pay attention, Don. Good question. Well done. Anybody else paying attention? Keith.
What if you have one buyer, say they're married, one buyer first time, one not?
That's a very good question. One that I can't answer, but
Okay, so for MFA, for first home, they do both have to be first-time home buyers. So the non-first-time home buyer would have to be 3 years since they had owned and occupied the property as their primary residence, since they owned, but that's for MFA.
And with Chenoa, they don't have to be first-time home buyers. There's no income limits and there's no first-time home buyer requirement.
anybody else? I think we all learned a new word too, Chenoa. Like, make sure you tell your friends. Go ahead. Do you have a question? Yes, please.
You mentioned with the MFA that you go with, it could go with VA. Can you explain how that works?
So the question is going with,
So how does that work?
Right,
correct.
so if your client fits VA, the best scenario, then our assistance can go towards, like if they have a funding fee. So some of the VA loans have funding fees. That's where we'd come in with that. And closing costs, yes.
Good question. Tico, go ahead.
Guys, I really appreciate you guys coming by and giving us the download. I really like the philosophy that Steve iterated that. That was, any buyer that, comes our way as lenders, you're always trying to find a solution. And some of the, niche products that you all have mentioned, I mean, those are great products to do that with. One question for Christine with Cross Country, Home Ready program, 97% LTV? Correct. Is that correct? Okay. And 50 to 80 AMI, right?
Correct.
You mentioned an area. You gave an example of an area used as an example. What was that area and what was the AMI?
The area was Eubank and Lomas, and the AMI was something like 82,000, but the program limit was 69,120. You're welcome.
Good question. Thank you, Dan. Tico, go ahead.
Targeted areas.
Yes.
We've had this conversation. To me, that seems like a huge opportunity that's being missed. And I'm working on trying to do a map overlay so we can have a good search for that. But it doesn't have to be a first-time home buyer.
Correct.
But it does have to be owner occupied, correct?
Yes.
Okay.
So for all of our programs, they do have to be owner-occupied primary residence. So even though we waive that first-time home buyer requirement for a targeted area, they, if they own a home currently, they'd have to move out of that home, obviously, and move into the new targeted area home. But yes.
Because those areas need somebody to come in and renovate.
Well, that's why we have these,
Yeah.
phenomenal rules for targeted areas, because exactly we're trying to revitalize these areas.
So offhand,
So it's about a 0.5% lower today. So yeah. Mhm. Yeah, so it'll be in the high fives.
Wow.
do the elephant in the room one. Also, sorry, since I got you up. Sometimes no lenders in this room have blamed MFA for not getting their job done. And it frustrates me because I know if they send you the package, there might be conditions, right, that come back from you. But even then, what's the turnaround time? If you get conditions, you send it back to Dan, and Dan's, like, oh, you got to send him this. Once he sends it back to you guys, how long is the turnaround?
So, yeah, and so it depends. And again, so keep in mind, after we look at it, your lender is going to need some time to, get the docs prepared on their end. But as far as once we do the initial review and we do what we call suspend, which means that we need maybe an updated pay stub to calculate income more accurately, or we're missing something. So it depends on the number of conditions that the lender has. So if there's 4 or less, then that's going to be a 1-day turnaround time. But if there's 5+, then that's going to be a 2 business day. And then keep in mind, everybody, we try to look at them as soon as we can. But if the lender submits conditions, say today, it's really not going to be looked at until the next day, right? So you're kind of looking at it like either 2 to 3 days. But hopefully it is the one shot, but there's always going to be questions, right? And of course, as everybody knows now, a lot of the loans are a little bit more difficult, right? It's not that cookie cutter buyer anymore. So it's most likely that we might have a question, especially for first home. First home is the one that we have to be a little bit more diligent with as far as questions, where that's home forward, it's a lot less restrictive, but it's less down payment, a little bit of a higher rate. But yeah, it's about that time. So again, it is going to take a little bit of time, but it's definitely not going to be, sitting at our office for weeks on end. If that's the case, it might be your client not getting the lender what they need or they're dragging their feet, right? But yeah, we're trying to get them as quickly as we can. And depending on the flow, as far as the number of files that we get in a day, if we review those files and we do have conditions, we're not going to sit on them just because, right? If there's time for our reviewers to look at those files, they're going to look at those conditions and try to get them out as soon as we can. So
I think there's two key takeaways from that. Good answer to that, Eunice, but two key things that you should know. One, develop a good relationship with the lender. I mean, you've got great options. You've got experts here in the room and on the panel. Develop a good relationship with them. And number two, set good expectations with your buyers. Remind them you're getting the benefit of, in some cases, free money, in some cases, an additional loan. You're getting down payment assistance. It's going to take a little bit of time. It's going to take a little bit of work, but you're getting that benefit in the end of not having to pay that additional money. So just kind of setting those expectations, I think, can help your buyers and understand they're getting a benefit. Do you have another question back in the back?
I need you all to re-point out which of the loans you can use for a multi-unit property.
I think the question was about multi-unit property. Who has multi?
Sorry, I'm going to try not to shout in the microphone. You can use both the programs that I was talking about on 2 to 4 units, but it does require at least 5% down, and they have to occupy it. So it's, yeah.
To get connected with Christine, she can help you. Another question, go ahead, Tanya. Go ahead.
Oh, I just wanted to ask, was it the CCM Smart Start that?
That was your.
CCM Smart Start?
Yes.
Okay.
Thank you. Go ahead.
Before they can move out.
So in general, MFA's rule is for all of our loans across the board, they have to owner occupy for at least 6 months. But keep in mind that depending on the loan type, if it's like an FHA or conventional, they might have specific rules too, right? That they'd have to owner occupy it longer, but just in a general sense, it's 6 months.
I would like to add.
Yes, okay.
That a lender would say at least 12.
Okay, one more question, go ahead.
For Eunice, so in those targeted areas, you said they'd have to move out, that they can own a home, but they'd have to move out and live in the targeted area. Can they rent out the existing home or do they have to sell it?
Yes, they can rent it out, the home that they currently own. But again, keep in mind that your lender has to kind of figure all that out because depending if they have to do FHA or conventional. But yes, let me just say it can be done, but it depends.
Good question. Carmen, go ahead.
Now that cannabis is legal here in the state, I have clients that work for cannabis industries. So what programs do you guys offer? Because I'm struggling to find, they're first-time home buyers as well, but they're struggling because a lot of lenders don't have programs that are designed for that since it's not legal on the federal level. What do you guys have for?
What's wrong? Their money is green. They have other things that are green, but what's wrong with those buyers? Just kidding.
So I would say, generally speaking, there's not going to be some sort of down payment assistance associated with that person. I can say at Cross Country Mortgage, we specifically have some niche products for cannabis income.
Percent down.
It's going to be 5 to 10%.
There's some options. There's some money out there. Good. Thank you. Rosemary, go ahead.
I didn't hear her question.
The question was about cannabis. Can you use it? Do you like it? Just kidding. The question was about cannabis programs, and if there's some out there, Christine and Cross Country Mortgage has some options for cannabis, not users, well, maybe users, but for those that are employed by cannabis companies. Thank you. Who else had questions? Go ahead, Dan.
Since we're talking about renovation loans and how important they are, especially in some areas within our community. Eunice, so MFA does 203K loans. How much time are you allotting for the construction period before you?
So it's gonna depend on, so you're gonna be using the FHA 203K. So you just have to follow those rules. We don't have any specific rules, yeah.
Do you follow agency guidelines on the underwrite?
Mhm.
So just to reiterate, I don't know much, but I'm gonna pretend like I do. 203K, let's say you have a buyer, they're looking for a house, they love the house, it's great, but it needs renovations. It needs something, just a little bit of love. That's where 203K comes in to allow you to have that money, borrow that money, and buy the house so you can fix it up. Kind of give you some information. So if you see the one that is not perfect and needs some love, maybe a 203K, talk to your lender, and maybe the 203K can be a good option for you. Maybe one or two more questions. Go ahead.
Which one did the first time home buyer programs allow co-signers?
So we do, but on a restrictive basis. So if somebody needs a cosigner to qualify, the only benefit for MFA using a cosigner is, I had mentioned that the DTI requirement for MFA is 50%. Well, with the cosigner, the home buyer can go up to 55%. So they get 5% leeway on it. But yeah, but we do allow it.
And Chenoa will allow non-occupying co-borrowers per FHA guidelines as well.
So that would be one of the reasons we would move out of MFA. A lot of people who are very low income or low income, they need the cosigner's income, which is crazy because how are they going to pay it? But maybe they're getting cannabis income. So we would almost never go MFA in that situation. We could do a cosigner on the programs I talked about, but they still have to be under that income limit. So that's it, correct. But on the Chenoa and the other down payment, no. And no cosigners for yours.
Any other questions? Anyone? Bueller? Just kidding. So thank you. I want to thank you all again for coming. We really appreciate it. I have 3 favors to ask before we depart. One, you've got some lovely people. You've got their contact information up here, and you have some lovely folks in the back. Want to thank GAR and the affiliates and all the staff for hosting us. But you've got some affiliates in the back. I heard there were jerky and cookies, so just make sure you check it out. Visit the booths in the back. Secondly, we learned some important things, right? We learned Chenoa. We learned some acronyms. A lot of different information. Make sure that you go and check out the GAR page for the affiliates information and for the GAR blog so you can see the slides on a bigger picture. And then the last one's a little more selfish and a little more personal. Again, thank you very, very much. We appreciate you being here. But some of you, this is on me. Some of you may have seen, I had a challenge. There was 100 reels and 100 deals that I have to do with Tom Ferry. So I have to do a reel. Would you guys be a part of my reel? Is that okay? Good. And if you shoot me an email or tag me, I don't know how it works. Ask my daughters. Anyway, I'll try and tag you in it as well. One more thing Antoinette mentioned, you do have surveys. So if you'll fill that out, give us some feedback on how we did, more information. But if it's okay, I'm going to do a reel real quick. Sorry, pardon the pun. And just wanted to shout out, we're here at GAR at the affiliates Q&A, and we're talking about first-time home buyers. If you can say hi, everybody. Let's do a wave. Everybody just give me a wave. Let's just start over here and just thank you for entertaining me. Thank you all for being here. We appreciate it. You all have a great day. Fill out your forms. Go visit the affiliates. Have a good day. What else, Steve?
Just one more thing I wanted to add. It's a side note. The backpack drive is going on, and we wanted to collect as many backpacks as we can for the kids for school. Director's Mortgage has ponied up. If we come up with 100 backpacks, they will match that. So we'll get another 100 from Director's Corporate. So if you guys can help out, certainly appreciate it. And I know the kids will, because a lot of them can't afford that. Thanks.
Let's get ready to round of applause again one more time. Thank you all again.